You scroll through the news. Another billionaire's net worth jumps by $10 billion in a single day. It's the kind of headline that makes your stomach sink, not because you care about the number itself, but because something invisible is happening right under your nose, something that keeps the ultra-wealthy pulling further ahead while the rest of the world scrambles to catch up. Here's the uncomfortable truth. It's not magic, it's a system, a hidden game designed to reward those who already have more. And the odds are stacked, not subtly, they are ruthlessly. Imagine a simple scenario. You have $1,000. You invest it in the stock market. Over a year, you get an 8% return. Not bad, right? That's $80. Feels tangible, feels earned. Now, imagine Jeff Bezos with $150 billion. He invests in the same way, same market, same time, but he doesn't get 8%. He gets leveraged access, insider influence, tax structures, and opportunities that aren't marketed anywhere. His $150 billion grows by $12 billion in a year. While you're celebrating $80, he's moving closer to $200 billion. And most of this growth is almost invisible in everyday life. The headlines make it sound like luck or genius, but it's neither. This is the hidden game. Not the stock market, not real estate, not crypto. Those are the playgrounds. The game is a series of rules, loopholes, and structural advantages built into the global financial system over decades. It rewards scale, secrecy, and timing. Let's take a step back. Why does this matter? Because while billionaires multiply their fortunes, middle-class wealth stagnates. Wages grow by single digits, inflation erodes purchasing power, and debt quietly swells. It's easy to shrug and say, that's life, but the reality is more deliberate and more uncomfortable than most people realize. The first rule of the game is compound advantage. Everyone knows compounding, money makes money, but most people miss how asymmetrical it is. The larger your base, the faster you grow. A 10% gain on $100 is $10. On $1 billion, it's $100 million. But compounding isn't linear here, it's exponential. And billionaires aren't just earning 10%, they're using mechanisms that increase their returns quietly, legally, but invisibly. Next comes tax arbitrage. Sounds boring, right? Wrong. It's the financial equivalent of having an invisibility cloak. The wealthy don't pay taxes on paper gains until they sell assets. Meanwhile, the middle class pays income tax, payroll tax, sales tax, often on money they've already spent. Jeff Bezos didn't avoid taxes in some shady way. He leveraged legal structures that let his wealth balloon while his taxable events were minimized. The system favors accumulation over circulation. Then there's the leverage multiplier. Banks, hedge funds, and private equity firms don't just invest money, they amplify it. A single dollar in a billionaire's portfolio isn't just sitting idle, it's borrowed, reinvested, and rotated across the globe. A single investment can touch hundreds of assets, creating multiple streams of gain. Meanwhile, if you borrow $1,000 for a car, you pay interest. If he borrows $1 billion for a tech acquisition, he pays almost nothing relative to potential upside, and the world subsidizes the risk. Here's where it gets ironic. The public market is portrayed as democratic. Everyone can invest. But the truth is, the game is stacked with invisible barriers. Billionaires have private deals, early access, and regulatory influence. When a tech IPO goes public, retail investors can buy, but the insiders have already made billions before the first trade. By the time you see the ticker, the money has moved. The system looks fair. It isn't. Let's anchor this in numbers. In 2022, the world added roughly $5 trillion to billionaire wealth. The S&P 500 barely moved by comparison. That's not a coincidence. That's the hidden game working as designed. Each $5 trillion is more than the GDP of most countries combined, and much of it never touches the real economy. It circulates in financial instruments that the average person can't access. And here's the quiet humor in it. The very media covering wealth often frames it as aspiration. Look at Elon, look at Jeff, look at these innovators. Inspirational headlines mask the structural reality. While innovation matters, structural leverage matters more.
You can work 80 hours a week. If you don't have scale, access, and the right financial tools, the math isn't on your side. The next layer of the game is asset inflation. Billionaires aren't just growing money, they're pushing up the prices of the things they buy. Luxury real estate, rare art, stocks, even startup valuations. Each purchase doesn't just reflect wealth, it increases the baseline for everyone else. That house you wanted? Sorry, it just got $2 million pricier because private equity is quietly bidding. Your investment is now harder to reach. The invisible hand isn't invisible, it's heavy. And the irony deepens. These gains are celebrated as personal triumphs, but much of the system depends on public money, public infrastructure, and public markets. Billionaires win by riding the waves created by everyone else, then doubling down in ways only they can. The rules are clear, but they're opaque to those inside the inner circle. By now, you might be asking, is this ethical, legal, sustainable? That's the discomfort. It's legal, it's systemic, and it has been carefully constructed over decades to favor scale, timing, and connections over merit alone. So how does the system work step by step? How does a billion-dollar fortune grow quietly while yours stagnates? That's the next act. But before we go there, pause for a moment. Look around you. The financial world isn't broken, it's designed. And if you want to understand the risks, the opportunities, and the unspoken math, you need to see the game for what it is, not what it looks like on a spreadsheet or a news headline.
Let's break it down. Step 1. Ownership of financial instruments. Billionaires don't just hold cash, they hold stakes in companies, private deals, and complex securities that appreciate faster than traditional investments. A startup valued at $100 million today can be $1 billion in 5 years. If you're lucky, you might get a share through public stock. They get it privately, pre-IPO, sometimes at a fraction of the public price. That's not luck, it's access. Step 2. Layered leverage. We touched on it before, but the mechanics are worth spelling out. Imagine a billionaire buys a company with $1 billion of his own money. Then he borrows $9 billion from banks at minimal interest. That's a 10x leverage. The company grows by 20%. Who benefits most? Not the banks, not the employees. They make their interest. The billionaire's $1 billion has now produced a gain on $10 billion in assets. The upside is enormous. And if the deal fails, losses are contained or socially absorbed. For you, a 10% investment loss can wipe out savings. The math is tilted. Step 3, tax strategy and deferral. It's not just avoiding taxes, it's timing. Wealthy individuals pay minimal tax on paper gains by reinvesting or holding assets. Capital gains are often taxed at lower rates than income. Deferred taxation, charitable deductions, offshore trusts, and stock-based compensation all create layers that slow down the tax drag. Meanwhile, your paycheck is taxed immediately. Every dollar you earn is a dollar less to grow. Step 4. Market influence. This is subtle but powerful. Large investors move markets just by participating. When a billionaire buys $100 million of stock, prices tick up. They can influence valuations, merge companies, or steer industries. Ordinary investors see the market move and react, but the rules they play by are shaped by the top. The free market is more like a VIP lounge with a public waiting line outside. And now the uncomfortable math. Let's say a billionaire's fortune grows at an average of 15% per year. Your $1,000 grows at 8%. 10 years later, you have about $2,160. They have roughly $4 billion. The multiplier effect isn't just big, it's staggering. Scale, leverage, access, and tax strategy combine to create exponential growth. Contrast this with public perception. Media loves the story of self-made billionaires. Inspirational narratives hide the structural reality. Sure, talent and risk matter, but these factors are a fraction of the story. The real engine is system design, rules, loopholes, and legal advantages that reward those who already have more. Zooming out, the implications are massive. Wealth concentration increases.
social mobility decreases, and economic cycles amplify inequality. Asset inflation affects everyone: housing, stocks, collectibles. Middle-class savings are squeezed, often chasing returns that the wealthy already captured upstream. And the system amplifies risk quietly. A leveraged bet that goes wrong for a billionaire might ripple through markets, while everyday savers feel the pinch immediately. Consider private equity, often glorified as sophisticated investing. A firm buys companies, cuts costs, and sells for profit. Employees often lose jobs, pensions can get squeezed, markets adjust. The partners? Millions, even billions. The math works perfectly for them, but the broader consequences are ignored. That's the hidden game in action: upside concentrated, downside dispersed. Irony is everywhere. We praise innovation and hard work, while structural advantages quietly do the heavy lifting. A billionaire's stock option package looks like a reward for genius. In reality, it's a legal instrument engineered to multiply wealth silently and predictably. Meanwhile, public financial advice focuses on budgeting, saving, and compounding pennies, valuable, yes, but dwarfed by the invisible forces shaping wealth at the top. And here's the kicker: the game isn't crashing anytime soon. Financial systems are designed to perpetuate this. Central banks, global markets, and regulatory frameworks all assume scale advantages are normal. Risk management is asymmetric. Big players get support, small players get risk exposure. Social safety nets, interest rate shifts, and policy tweaks often preserve the hidden advantage rather than correct it. So what does this mean for you? Not despair. Understanding the system is power. Awareness allows smarter decisions, strategic investing, tax optimization, timing, and positioning within networks. But the bigger truth remains: the game itself is built to favor scale, access, and leverage. Playing by ordinary rules guarantees slower growth. Playing outside it, legal, strategic, and informed, opens doors that most never see. And finally, the unresolved question: how long can this continue? Will wealth concentration reach tipping points that destabilize markets? Will the invisible math eventually collide with social and political realities? Or will the system quietly expand, rewarding scale, influence, and timing indefinitely? You may never hold $10 billion. You may never sit at the tables where private deals shape industries before the public hears a word. But the game surrounds all of us. Understanding its rules, spotting the hidden mechanisms, and recognizing the math is the first step to seeing the economy for what it is. Not the headlines, not the hype, but the quiet, relentless logic that makes billionaires richer every single year. And the thought that lingers uncomfortably as you scroll through your own investments tonight: if the system is designed this way, what part of your financial life is shaped by your choices, and what part is shaped by rules you didn't even know existed?